Welcome to the Deep Dive, where we take your sources and really unpack the most important nuggets of knowledge. Today, we're diving into a case study. It's about Oragenics, Inc., ticker symbol OGEN. And at first glance, you might think, okay, maybe this is one of those biotech success stories in the making. But when you look closer, especially at this comprehensive report we've got in front of us, well, the picture gets a lot more complex and, frankly, pretty startling.
Yeah, that's right. The report actually concludes it's the exact opposite of a sound investment.
Exactly.
We're looking at a really detailed analysis here. It's called OGEN Price Movement Analysis, and it uses, a rigorous value investing framework to dissect this microcap biotech. So our mission today, to pull out the real story behind OGN's recent stock price moves, understand why it matters, and importantly, identify the critical lessons it offers about what truly makes a business robust.
That's right. So if you're looking to understand the mechanics behind market volatility and maybe what separates a genuine long-term investment from, let's say, high-stakes gamble, this deep dive is definitely for you. We're going to break down how Oragenics measures up against some foundational investment principles. And you might be surprised by what we find. It could offer some real insights for your own investment journey. Let's get started. Okay, let's dive into Chapter 1, Executive Summary and Investment Thesis. Now, our source kicks off with a pretty blunt executive summary of Oragenics. So right off the bat, what's the core investment thesis presented here?
Well, the report's verdict is crystal clear. It states Oragenics is the exact antithesis of a sound value investment.
Antithesis. Strong word.
Very. It's described as basically a financially distressed, pre-revenue, clinical stage biotech company. And it's equity. It functions purely as a high-risk speculative instrument. It fundamentally fails the basic tenets of, say, the Buffett-monger investment philosophy. Lacking simplicity, no real economic moat. And it shows management actions that seem pretty misaligned with long-term shareholder value. Crucially, the report concludes it has a negative intrinsic value from its operations. That means, essentially, no margin of safety at any price.
Well, okay. Negative intrinsic value. That's quite a statement. Now, the report highlights significant stock price volatility on July 1st, 2025. What did the market data actually show that day? Because there was some confusion, wasn't there?
Yeah, contrary to some initial maybe speculation about a price surge, the data confirms Oragenics actually experienced a severe pre-market decline.
A decline.
A significant one, approximately 21.5% on July 1st, 2025. And this wasn't random volatility. It was a direct, almost textbook rational market reaction to a very specific event that happened overnight.
Okay, what was the event?
The U.S. Securities and Exchange Commission, the SEC, declared the company's Form S-1 registration statement effective. That happened at 12:15 a.m. Eastern Time that day.
Right, the S1 going effective. So the market plunged immediately after. What exactly was in that filing that caused such a swift and severe reaction?
Well, this S-1 filing was the bombshell, really. It detailed what's called a best efforts offering. They aimed to raise up to $20 million in Series H non-voting convertible preferred stock, and it came with warrants attached.
Okay.
But the key, the really damaging part for existing shareholders, is its full ratchet anti-dilution provision.
Oh, ratchet. Can you break that down? What does that actually mean for an investor?
Sure. It means if Oragenics issues any new shares at a lower price in the future, and given their situation, that's quite likely, the conversion price for all these Series H preferred shares automatically drops down at that new lower price. This creates the potential for, well, massive, almost unquantifiable dilution for the existing common stockholders. It can create a kind of death spiral financing situation where each new round of funding at a lower price triggers even more dilution.
Yikes.
So the market's sharp negative reaction, it was basically efficiently pricing in this immediate threat.
Right. So it makes sense then that the report gives an unequivocal avoid recommendation for any long-term value-oriented investor. It sounds less like an investment opportunity and more like a financial minefield.
That's a good way to put it.
Okay, let's move to Chapter 2. Oragenics, Inc., an examination of the business and its management. Let's turn our attention to the company itself. Oragenics seems to have a history of strategic pivots, almost like a chameleon, right? Can you walk us through its corporate journey?
Yeah, they've definitely shifted focus. Oragenics initially started in antibiotic research, then kind of opportunistically shifted into infectious diseases. They had a COVID-19 vaccine effort back in 2020.
I remember that.
Right. But the most significant transformation, the big one, came in January 2024. That's when they acquired neurological assets from a company called Odyssey Health, Inc., and that became their sole focus. Specifically, their lead program, ONP-002, which targets mild traumatic brain injury or concussion.
Okay, you mentioned the Odyssey Health acquisition. Now, what did the report dig up about that particular transaction? Was there anything, well, out of the ordinary there?
Yes. And this, according to the report, is a profound warning sign, a really big one.
Okay.
Just 5 months, only 5 months after Oragenics acquired its main technology, ONP-002, from Odyssey. Odyssey Health, which is a 10% owner of Oragenics at the time, systematically sold its entire estate.
The entire estate.
Every single share. Between June 13th and June 18th, 2025, they reduced their holding from 10% down to 0.
Wow.
Now, typically, a company selling what it claims is promising technology would retain some equity. They'd want some upside if it succeeds, right? Odyssey's complete divestment, and this was at post-reverse split prices, averaging around $4.30 per share. The report describes this as a powerful vote of no confidence.
A vote of no confidence.
From the very party, the only party really, with the most intimate knowledge of ONP-002's preclinical data. This action severely undermines the credibility of Oragenics' sole significant asset.
Wait, so let me get this straight. The original seller of the technology bailed completely just 5 months later. That's a massive red flag, isn't it?
It's hard to overstate how concerning that is, yes.
Okay. So, turning to Oragenics' management team, who are the key players there, and what does their structure maybe tell us about the company's true operational focus?
Well, Janet Huffman serves as both CEO and CFO. That's a combined role.
Interesting.
And Dr. James P. Kelly, who's a recognized expert in traumatic brain injury, TBI, is the chief medical officer. The board includes some long-serving members like Charles L. Pope, who's the chairman, and he actually has a CFO background too.
CEO-CFO combo, chairman with a finance background.
Exactly. This structure, especially that combined CEO-CFO role and the chairman's financial expertise, it really underscores something the report highlights. In this kind of microcap, pre-revenue biotech, the primary business activity often isn't commerce or product sales. It's almost entirely about capital acquisition, raising money to fund the R&D.
So management success metric becomes, can they secure the next round of funding, which, as we discussed, can be detrimental to existing shareholders.
Yeah.
How does that reality align with their publicly stated business strategy and competitive advantages?
Well, publicly, Oragenics states its mission is to pioneer neurological health solutions. They highlight ONP-002 as a first-in-class opportunity. They talk about a projected $8.9 billion concussion market by 2027.
Big numbers.
Big numbers. And they emphasize robust intellectual property protection they expect until 2040. They even announced a partnership with BrainBox Solutions recently.
Okay, on the surface, that market opportunity, the IP, it sounds promising. But with these biotech stories, I feel like there's often a catch. What's the report's take on the actual potential versus the hype here?
There's definitely a catch highlighted. This optimistic public narrative stands in really stark contrast to their mandatory SEC filings, specifically their 2024 annual report, the Form 10-K.
What does the 10-K say?
That report explicitly states the company's strategy involves a continuous search for strategic alliances, licensing deals, equity or debt-based investments, basically ways to get cash. And crucially, it also acknowledges in black and white that most product candidates do not make it past the clinical development stage. So this creates a kind of dual narrative, right? On one hand, they present as a focused drug development company chasing a breakthrough. On the other, their filings reveal a company whose actual business model seems to be leveraging the story of ONP-002 to perpetually raise capital. And that model, the report argues, is fundamentally incompatible with value investing.
Right. That leads us perfectly into Chapter 3, analysis of financial condition and capital structure integrity. Given that picture of management and strategy, it's probably no surprise what the report found when it dug into Oragenics' financial health. What's the bottom line there?
Yeah, no real surprises. It reveals a company in, well, perpetual financial distress. As a clinical stage entity, remember, it has no meaningful revenue from product sales. And it consistently incurs substantial operating losses. We're talking $10.6 million in fiscal year 2024, another $2.2 million just in the first quarter of 2025.
Oof.
This has led to a staggering accumulated deficit. By the end of 2024, it stood at $216.8 million.
$250 million in losses accumulated. And the auditors even flagged something significant in their report, didn't they?
They did. Their independent auditors included what's called an explanatory paragraph in the 2024 annual report. It specifically regarded the company's ability to continue as a going concern.
Going concern. That's auditor speak for we're worried they might not survive.
Yeah, exactly. It's a critical red flag. It signifies substantial doubt about Oragenics' ability to meet its financial obligations and just remain operational over the next year without securing significant additional capital. And just to give you some context here, as of March 31st, 2025, their total shareholders' equity, the book value of the company, was a razor-thin $137,688.
Wow. Less than $140,000 for the entire company's equity. That's precarious.
Extremely. You can see these numbers laid out clearly in Table 3.1 of the report. It's consistent negative cash flow from operations.
Okay, so let's talk about that 1-for-30 reverse stock split they executed back on June 3rd, 2025. The CEO framed it as something to strengthen capital markets presence. But what was the real motivation, according to this analysis?
The report is pretty clear. It was a necessary tool for survival, not some strategy for value creation. Reverse splits are fundamentally cosmetic adjustments. They don't change the underlying value. Oragenics had actually received deficiency letters from the NYSE American Exchange because they were failing to meet listing standards, including minimum stockholders' equity requirements. So, step one was avoid delisting. But more importantly, it was a crucial preparatory step for future financing. It artificially boosts the share price, making the stock look more palatable maybe to institutional investors who often have rules against buying stocks under $1 or even under $5.
So it greases the wheels for more fundraising.
Precisely. But the market almost universally interprets reverse splits as a sign of profound corporate weakness and distress.
Yeah, usually not a good sign. Which brings us right back to that Series H offering, the one filed just weeks after the reverse split. The report calls it toxic financing. We've touched on the full ratchet provision, but what else makes it so detrimental to common stockholders?
Well, beyond that full ratchet anti-dilution provision, which is really the most pernicious feature, the offering structure itself is problematic. It has no minimum raise requirement, meaning they could raise very little money, maybe not enough to significantly extend their runway, but the toxic terms would still be in place. There's also no escrow, meaning the funds aren't held pending certain conditions, and the securities themselves are illiquid hard for those preferred investors to sell. It's described as a textbook financial maneuver by a cash-starved company, focused squarely on survival, whatever the cost to its existing owners, the common shareholders. Table 3.2 in the report details the offering size, the unit price, and those key damaging provisions.
Got it. Survival mode, whatever the cost to current investors. Okay, let's move into the second part of our analysis, Chapter 4, the ONP002 pipeline, a clinical and commercial assessment. So we've established pretty clearly that the company's future basically rests on this one clinical asset, ONP002. Remind us, what is this candidate designed to do, and what's its current development status?
Right, ONP002. It's described as a first-in-class, fully synthetic neurosteroid. It's designed for intranasal administration, so a nasal spray to treat mild traumatic brain injury or concussion.
How's it supposed to work?
The proposed mechanism is that it crosses the blood-brain barrier relatively easily, and then works to reduce inflammation, oxidative stress, and swelling in the brain after an injury. Now, development status. Oragenics has completed the preclinical studies, lab and animal work, and they've done a phase I human safety trial, which showed it was generally well tolerated.
Okay, phase I done. What's next?
They are now preparing to initiate a pivotal phase I clinical trial that's planned for Australia. They've submitted the required investigators brochure. This is a really critical juncture because they're moving from just proving it's safe to trying to prove it actually works, assessing efficacy. You can see a summary in Table 4.1.
Right. Phase 2 is where many drugs stumble. Now, the investor materials, as you mentioned, often highlight the significant market opportunity for a concussion treatment. Is that part accurate? Is the market really that big?
The potential market opportunity is significant, yes. There's a projected global market size of around $8.9 billion by 2027. And importantly, there is currently no FDA-approved pharmaceutical therapy specifically for concussion. So the unmet medical need is definitely undeniable.
Okay, big market, unmet need. But here comes the but, right? This sounds like huge potential if they succeed. What's the catch?
Here's the critical counterpoint for any investor, especially a value investor. You have to rigorously balance that potential market size against the profound risks inherent in biopharmaceutical development. It's just the nature of the beast.
High failure rates.
Exactly. The company's own 10K filings acknowledge the very high probability that product candidates will fail. And for a company like Oragenics, with basically a single asset pipeline, this risk is essentially binary,
Binary.
meaning it either works spectacularly well or it fails completely. There's very little middle ground. That multi-billion-dollar total addressable market, the TAM, that's a theoretical ceiling. It's not the probable outcome. Given the historically low success rates, especially for neurological drugs, the risk-adjusted value of ONP-002 is likely a minuscule fraction of that theoretical multi-billion-dollar market.
And then there's that Odyssey Health issue.
And let's not forget the complete divestment by Odyssey Health, the asset's originator. That casts a very deep, concerning shadow over its perceived quality and its actual probability of success. Why would the people who know it best sell all their shares if they truly believed in it?
Good question. Okay, what about intellectual property? They claim strong IP protection until 2040. Does that offer any real protection or value?
Well, Oragenics does report having pending patent applications for both the ONP-0002 compound itself and its proprietary intranasal delivery device. And yes, they anticipate this could provide market exclusivity until 2040. Could, because patents only provide a real economic moat. If, and this is a huge if, the underlying product is actually proven safe and effective in large trials, if it receives regulatory approval from the FDA and others, and if it's then successfully commercialized. If ONP-002 fails in its clinical trials, phase 2 or phase 3, its associated patents become effectively worthless paper. The value of the intellectual property is entirely contingent on clinical success, making the IP itself just as speculative as the drug candidate.
So the patent is only valuable if the drug works, which is the big question mark.
Precisely.
Okay, this brings us to Chapter 5, A Value Investor's Verdict. Oragenics versus Buffett's 4 pillars. Now let's take all this information, the business model, the management actions, the financials, the pipeline risk, and apply it to a rigorous framework. Warren Buffett's famous 4 fundamental pillars of value investing. How does Oragenics stack up against these foundational principles?
Right. This is where the rubber meets the road for a value approach. And the conclusion from the report is pretty stark. It fails to meet any of the criteria required for consideration as a value investment.
Okay, let's go through them. Pillar 1. Is the business simple and understandable?
Well, a drug for concussions sounds simple on the surface. But as we've discussed, Oragenics' primary business seems to be complex financial engineering designed mainly for corporate survival.
Right, the capital raising.
Exactly. Navigating SEC regulations, maintaining exchange compliance, and most critically, raising capital through continuous dilutive offerings. A value investor typically looks for a proven, understandable model for generating actual profit, not these perpetual high-stakes financial maneuvers. So, on Pillar 1, the report's verdict is fails.
Okay. Pillar 1 fails. How about Pillar 2? Does the business have a durable competitive advantage? Economic moat.
Oragenics has no such moat. None. As a pre-revenue entity, it literally has no profits to protect. Its entire future rests on that single, unproven drug candidate just entering mid-stage trials. And as we just talked about, its patent portfolio is only a potential future moat. It's entirely speculative at this point. So Pillar 2 also fails.
2 for 2. Okay, Pillar 3. Is management able and trustworthy? This one seems tricky. They've kept the company afloat.
They are certainly able to keep the company solvent, yes, through these capital raises, but the report argues their actions demonstrate a profound misalignment with long-term shareholder interests. The repeated use of these shareholder-unfriendly financing tools, like the reverse stock split, immediately followed by that toxic Series H preferred stock offering, it strongly suggests they prioritize corporate survival, keeping the lights on over increasing the actual per-share value for existing investors.
And the Odyssey sale factors in here too?
Absolutely. The fact that Odyssey Health, their key technology partner, completely liquidated its substantial stake is seen as a damning indictment, reflecting poorly on either the asset's prospects or management's handling of it, or both. So on Pillar 3, evaluating management's alignment with shareholders, it fails.
All right, 3 down. What about the final one, Pillar 4? Is there a margin of safety?
This is perhaps the most crucial for a value investor, and Oragenics offers no margin of safety whatsoever. Why? Because its intrinsic business value is assessed as negative. It has a long history of negative earnings, it had negative shareholder equity at points, it consistently burns through cash with no offsetting revenue. The stock price itself, closing at $3.82 on July 1st, 2025, according to the report, isn't seen as a reflection of underlying business value. It's viewed as pure speculation.
And the volatility.
That wild 52-week trading range mentioned in the report, from $3.12 all the way up to $75.60, that just further highlights its speculative nature. Buying shares at any price here is essentially a gamble, a bet on a low-probability clinical outcome, not an investment with a safety net. So Pillar 4, unequivocally, fails.
So a clean sweep. Failing all 4 pillars according to this value investing framework, that's laid out pretty comprehensively in Table 5.1 of the report.
It is a clear rejection from that specific perspective.
Okay, let's zoom back in now for Chapter 6, Anatomy of a Volatile Day. Deconstructing the July 1, 2025 price collapse. We established this wasn't just random market noise. What specific series of corporate actions really set the stage for this volatility? Can you recap that timeline?
Yeah, the conditions were very clearly established by a rapid succession of events, all happening in June 2025. And they really form a clear narrative, pointing towards a company preparing for a major dilutive financing. So first, June 3rd. The 1-for-30 reverse stock split became effective. That artificially inflated the per-share price. Then June 13th to 18th, Odyssey Health, Inc. sold all its shares, that profound vote of no confidence we discussed.
Right.
Then June 23rd, the Form S-1 was filed for that highly dilutive $20 million Series H convertible preferred stock offering, the one with the toxic full ratchet provision. June 30th, an S-1A amendment was filed, basically signaling the offering was moving forward, details finalized. And then the final trigger, July 1st, 12:15 a.m. ET. The SEC declared the S-1 effective. Boom. The threat of dilution became immediate and real. This timeline is detailed nicely in Table 6.1.
So just to reiterate, that initial query someone might have had about a pre-market surge was fundamentally incorrect based on the data.
Completely incorrect. The data directly refutes that premise. On the morning of July 1st, Oragenics was actually listed among the top pre-market losers. Its price plummeted by 21.47% down to $3.
Okay.
And this sharp decline, again, was a direct and, frankly, rational reaction to the SEC's overnight clearance. The market immediately started pricing in that impending, potentially massive dilution from the full ratchet provision.
Okay, so it tanked pre-market.
Yeah.
What about the intraday volatility after that initial collapse? How did it trade during the actual session?
Well, the stock remained highly volatile, trading in a range between $3.58 and $4, still reflecting significant weakness compared to previous levels. You have to remember, this is a micro-cap stock.
Tiny company.
Very tiny. A market capitalization of only about $2.5 million at that time, and a very small public float. The number of shares actually available for trading was estimated around 700,000 shares.
So small float means big swings possible.
Exactly. OGN is inherently susceptible to huge price swings on relatively low trading volume. But more importantly, it carried extremely high short interest.
Meaning lots of people betting against it.
A lot. The report cites figures ranging between 11.56% and even up to 41.46% of the float being sold short. That's a very strong bearish signal. And get this. The cost to borrow the shares needed to short the stock was exceptionally high. It hit 377.33% on an annualized basis on June 30th.
Wow. 377% interest to borrow.
Yeah, that indicates incredibly high conviction from short sellers that the price was going down. So when that S1 became effective, it was major fundamental validation for their bearish thesis. They likely pressed their bets, increasing their short positions and exerting further downward pressure on the price.
So from a technical analysis standpoint, this big drop on July 1st, was this the start of a newer negative trend, or was it just accelerating something already in place?
Definitely not a new trend. The stock was already in a confirmed and severe downtrend before July 1st. It was trading significantly below all its key moving averages, the 50-day, the 100-day, the 200-day.
Which are indicators of?
Indicators of a long-term bear market for the stock. The S1 news didn't create this negative trend. It simply provided a powerful fundamental catalyst that dramatically accelerated the existing negative technical momentum.
Got it. Poured gasoline on an existing fire.
That's a fair analogy, yes.
Okay, let's bring it all together in Chapter 7. Synthesis of findings, comprehensive risk profile, and final recommendation. So, to synthesize everything we've discussed, what are the main overarching conclusions from this comprehensive analysis of Oragenics, Inc.?
Well, the analysis really points to a cohesive set of conclusions. First, Oragenics appears to function fundamentally as a speculative vehicle for a single, unproven clinical asset. It's not really operating like a traditional business creating value through, sales and operations. Second, its financial foundation is exceptionally weak. Consistent losses, that going concern warning from the auditors, and a clear reliance on shareholder-unfriendly financing methods. Third, management's actions, like the reverse split followed immediately by the toxic preferred stock offering, seem to prioritize corporate survival over enhancing per-share value for existing owners.
And the asset itself.
Fourth, the sole asset, ONP002, carries immense binary risk. It works or it doesn't. And that risk is significantly amplified by its originator, Odyssey Health, completely divesting its stake. And finally, that July 1st price decline wasn't random. It was a direct, logical, and frankly predictable market reaction to the confirmation of imminent, highly dilutive financing.
That paints a very clear and risky picture. Can you outline the comprehensive risk profile? What are the key dangers for anyone even considering this stock?
Certainly. An investment in Oragenics carries a multitude of significant overlapping risks. The report highlights these. First, financial risk. There's an imminent and continuous need for more capital. They have a history of losses, negative cash flow, that going concern warning, and therefore an acute risk of insolvency if they can't raise funds. Second, dilution risk. This is perhaps the most immediate and certain risk right now. That Series H preferred stock, with its full ratchet anti-dilution provision, pretty much ensures severe dilution for common shareholders in any future financing rounds. It's a major trap. Third, clinical risk. As we've said, the investment is essentially a binary bet on ONP002's success. The probability of failure in Phase 2 historically is quite high for neurological drugs. A negative trial result would likely lead to a catastrophic loss of value. Fourth, market risk. It's a low-float, microcap security. That means it's subject to extreme volatility and price movements that can be completely disconnected from fundamentals. And the high short interest makes it a constant battleground stock, adding another layer of unpredictability. And finally, management risk. There's a demonstrated track record here of corporate actions that have been detrimental to long-term common equity value. Actions seemingly driven more by the need to keep the corporate entity afloat, rather than enriching its owners.
It's a lot of risk factors. What about broader macroeconomic things, like, say, potential U.S. tariffs on the biotech sector? Do they play a significant role here, according to the report?
That's an interesting point. While U.S. tariffs, which could potentially increase manufacturing costs or disrupt supply chains, are certainly valid macroeconomic headwinds for the biotech industry as a whole, the report suggests they are a much lower order risk for Oragenics specifically.
Why is that?
Well, look, for a company facing truly existential challenges like running out of cash within months and the potential imminent failure of its only clinical asset, worrying about incremental costs from tariffs is, well, it's like worrying about the paint color when the house is on fire.
Bigger fish to fry.
Much bigger fish. The company has to survive its internal financial and clinical crises first. Tariffs are a distant concern in comparison.
Okay. So bringing it all home for you, our listener, what's the final recommendation and the main concluding thought from this deep dive based on the source material?
The report unequivocally reiterates its avoid recommendation for any investor who adheres to the principles of value investing. Oragenics, Inc., based on this analysis, simply fails every single test of that disciplined approach. It's described as a complex and unpredictable financial entity, not a simple, understandable business focused on value creation. It lacks any kind of durable competitive advantage or moat. Its management, judging by their actions documented in the report, hasn't demonstrated a clear commitment to building long-term per-share value for common stockholders. And most importantly, it offers absolutely no margin of safety. Its market price appears to be purely a function of hope and speculation, while its intrinsic business value is assessed as negative.
So definitely not for the value investor,
Right.
but maybe for traders.
Well, the report concedes it might appeal to highly risk-tolerant short-term traders. Those who specialize in volatile, news-driven microcap equities and try to play the swings, but it holds absolutely no characteristics that would appeal to a long-term investor seeking to compound capital safely and predictably over time.
The gap between the speculative price and the fundamental value is just too large.
Exactly. The chasm between its speculative market price and its fundamental value is seen as vast, and under the current circumstances described, unbridgeable.
So the key lesson here for you, the listener, is
always dig beyond the headlines, especially with complex stories like this. Understand the true operational reality, the financial engineering at play, and the real risks involved in any company before you even think about investing.
And that's our deep dive into Oragenics, Inc., ticker OGEN. We really hope this exploration has given you some valuable insights into how to dissect these often complex financial narratives.
Yeah, remember, understanding the underlying principles, the business fundamentals, and especially the risks involved is just crucial, particularly in volatile markets where headlines can be really deceiving.
Absolutely. If you found this deep dive valuable, we'd love it if you'd like and subscribe to Stock Analytics AI. For just $4.99 a month, our members get priority deep dives on tickers they request. Plus, over the next few months, we're actually planning to cover all of the S&P 500 stocks, and members will get exclusive priority access to those analyses.
And hey, if you just want a one-off deep dive on a specific ticker that interests you, you can always drop us a super thanks right here on the video.
We appreciate the support.
Now, just the standard but important note. All the analysis provided in this deep dive is based on AI-generated research and publicly available information, and it's current as of July 1st, 2025. It is strictly for informational purposes only and should not be considered financial advice. We strongly encourage you to always conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions.
Sound advice. Thanks again for diving deep with us today. We'll be back soon with another illuminating deep dive.